All right, everyone. Hope everyone is okay. Welcome to Module 3, the approach to our trading. This is Lesson 1, the elements to a trade setup. So we're just going to go over different key points of what price does, and we're going to describe certain conditions that the market presents to us, and hopefully you will have a bit more of an understanding of the way we're looking to try and move in the markets and the idea of how we look to extract results within the markets just by understanding what it actually does and why it does it. And the rest of this module is going to basically dive a little bit more into what's firstly explained in this lesson. So it will pick up key areas and things like that. So it's a really exciting module. It's definitely one to make sure you plug into, and it's something you definitely need to understand before we start diving even deeper into modules 4 and 5. So without further ado, let's get moving. So your elements to a trade setup, you have to consider certain areas. Okay, so there are different types of market conditions, and they are formed of an expansion, a retracement, a reversal, and consolidation. They are the only 4 conditions you need to consider for this trading strategy. I don't know how many others are out there in terms of what you would learn if you were a retail trader, but this is all you need to focus on when it comes to what the market does. And we're going to break down each condition and give you some examples of what they actually are, and hopefully this will basically explain a little bit more about those conditions. But other things we need to consider with how we're actually going to use these conditions. So we now need to consider levels and areas we use to formulate a plan with the above conditions. Okay, so once we can identify what an expansion is, what a retracement is, what a reversal is, and what consolidation is, we need to identify how we use them to get ourselves into the marketplace. And we are going to look at candles, we're going to look at imbalances, we're going to look at liquidity pools and liquidity grabs, and we're going to look at discount and premium levels, which can be put under the same bracket as equilibrium. That is a 50% marker. Equilibrium is a very powerful tool in this idea of trading. So that is all we need to kind of consider, and there are going to be very separate and inclusive lessons which will talk about candles, which will talk about imbalances, and which will talk about liquidity as well as premium and discount levels, and that's all going to be covered in this module. So if you are unsure on candles, areas, imbalances, liquidity, things like that, do not panic, because it's all going to be covered in future lessons. This is just to give you the idea, the kind of like the foundation of what we need to do. So this is treated for anyone that is even a beginner or anyone that has got an understanding of what we're doing but just wants to level up. This is a really good lesson for anyone of any ability. So essentially this here represents the market, and this big circle that we see is the marketplace. Within there is liquidity. So the blue area here signals liquidity. So the big blue circle is money being injected into the market via the banks, via the institutions. They control the marketplace, which is why they've got the bigger circle. They are responsible for injecting extremely high amounts of volatility into the markets. I think the last stat that was reported that last year it was about $6 trillion injected throughout the marketplace just on Forex alone, and that is every single day, 5 days a week. So just to put it into context of how much money that actually is, consider all of that inside of this circle. Now inside of the circle you have got 2 other different types of organizations, should we say. So obviously the banks and the institutions are the ones with the extremely high lot sizes. With retail traders, we can call that speculative money, and they are responsible for a huge portion of the money and liquidity injected through the markets every single day, 5 days a week, Monday to Friday. And the reason we call it speculative money is simply because it's guesswork. Okay, you could call it, if you've heard before, dumb money. But essentially, it is speculative money. It's people going and acting via certain patterns, certain triangles and levels and indicators and things like that. And there'll be plenty of examples along the way of why you shouldn't really trade along line with the retail traders. And this will kind of explain why. But just to put it into context, that is, really a demonstration of how much speculative money is in the markets. And smart money traders put in a much smaller amounts because they are the sensible traders, if you like. And it's a smaller amount because we all put liquidity in the markets. Every time you are investing into the marketplace with your stop loss, you are injecting liquidity in the markets. Whether or not you come up with profit is a different thing. Exactly the same goes for the retail traders, but there are less of us in terms of who is actually trading in the marketplace. And the idea behind the way we trade is simply that we follow the coattails of the banks and the institutions. Now, we're not making anywhere near the money that the banks and institutions are making, but we are joining them in getting in on liquidity pools and liquidity grabs that are made via taking out the speculative money traders, i.e. the retail traders. So this is just really to give you an understanding of what it constitutes as in the marketplace. So we've got price, which is the algorithm you see on the charts every single day being moved up and down. Whether you see a red candle, whether you see a green candle, it is price moving in a certain direction. And within it, this just represents the cycle that happens within the marketplace every single day. So obviously there's your retracement, okay, moving from the expansion, going into a consolidation, and at some point we're going to get a reversal. And we're going to go over what each one means and what it kind of represents. But essentially, it is, think of it as a cycle around the algorithm of price. So, expansion. Expansion is price moving quickly from a key level in the markets. When price expands quickly, it is indicating a willingness on the directional bias of the markets. We use expansion to then identify key areas where price needs to come back to mitigate into, which could go under candles and imbalances. So effectively, when price expands to the upside or the downside, it leaves orders in drawdown, which can be identified as our key areas. And price is moving quickly to the upside, which is what indicates it is expansion. So it is giving us the idea that it wants to move in a certain direction. And when it comes back to mitigate into those areas, that's what we're looking for price to end up doing. So just to show you what's kind of going on here, this highlighted area here is expansion away from this level here. Now, what you can identify with these candles and areas and wicks and things like that is that price actually finished below here, creating this liquidity grab right here, because we can find liquidity under here, which is money. That goes under liquidity pools. And again, if you're unsure on liquidity, there's no need to panic. We're going to go over all of that. But this is for the sake of showing you an expansion. This here is expansion away from this level here. And we identify this candle here as a key area. And again, candles is going to be kind of a topic we're going to go over. So again, do not worry. But long story short, we can see that this is a candle that price needs to mitigate back into, because there are orders left inside this candle. And as you can see, price has actually come back from this expansion and then moved again to the upside. So now price has moved to the upside after coming back to mitigate. We've expanded, showing our intent that price wants to move higher. So when we see these big pushes to the upside here, we can identify key areas within here, such as this candle. maybe this candle and this candle, which can form as your kind of order block area, this imbalance, which is within the order block. You know, there's all sorts of areas that we can look at within here as well. Your equilibrium is measuring this trading range here and measuring 50% of the area, and below 50% is going to be your discount level. And on a selling condition marketplace, you're looking for a premium area. Again, we're going to go over that, so do not panic. But essentially, just for the sake of showing you the expansion, that there is price moving quickly from its intended area, showing us willingness to move higher. So a retracement. Retracement is when price moves back into our key area, which was created from the expansion. When price retraces back into our expansion levels, this indicates price is willing to come back and mitigate the orders which were left behind from the expansion. We look for key areas such as candles and imbalances. So effectively, when price expands to the upside, it leaves areas in drawdown. So price was selling and then it bought, as an example. When price buys high, it leaves sell orders in the market. Sell orders can identify as a candle when we are analyzing the charts. And price has to come back and retrace into that area to mitigate. The reason it does that is because the volatility which is created via the banks and the institutions have an interest to go back there, because they know there is going to be liquidity resting there with their orders. So they are pulling price back down and then going in their intended direction. And it then makes up the cycle of what we're looking to do. So I've created another example here. And as you can see, you know, this is kind of our massive expansion to the upside here. And I've identified this candle, which is the last down candle before price has moved higher. Now, the reason I'm counting this candle here and not this one here is because that there is a doji candle. There's not a lot of volume in there compared to what is in this candle here. And again, this is going to be covered in future lessons. But essentially, this candle here was responsible for this liquidity grab just under here. And then price expanded to the upside. And as you can see, price is then retracing down, respecting the level that the expansion created. So we've not come in below. And we've actually come back to this key area here, this candle that price needs to be mitigated back into. And then it's gone in its intended direction. So we can see the expansion. We can identify our key areas, which is this candle here. And we can use this as an area that we want to get into price. And then price pushes higher. And then what you can obviously identify is that when price was retracing down just into this candle here, the second we got into this candle with maybe 1 pip in drawdown, price expands and then retraces back down into this area of 3 candles, also known as an order block. And then price pushes higher. Once price pushes even higher above here, we've got this expansion, we've got this retracement coming down into this level, and then price pushes higher. So hopefully you can identify the cycle of what price is actually doing and identify certain areas where we could potentially look to get into the market, because you could have been a buyer right here. You could have been a buyer here. You could have been a buyer here. And that there is your target. So your retracement is price coming back into a level that was created via the expansion. So a reversal. This is when price moves in the opposite direction from the current bias, i.e. we are breaking structure. When this happens, price is indicating its willingness to shift in the opposite direction as what previously intended by the algorithm. We look for liquidity pools just above an old price high and just above an old price low. So essentially, let's say, for argument's sake, price is trending up. When price is trending up, at some point price is going to reverse to the downside, which means we're breaking previous structure. So I will show you some examples of what that is. But essentially, we use this as a key level to then look for moves to the downside or the upside, depending on which way price has actually broken structure. So what we've got here is price reversing. So as you can see, price here, if you follow it down from where my mouse is, we can see price is coming down. We can see this low's been created, we then come down again, and we're respecting this level here. So that's your, expansion to its downside, retracement up, expansion coming down. You would expect a retracement into this level here, but you can see an expansion in the opposite direction. So we've broken structure. And what I meant in the third point about looking for liquidity pools below an old low, you can see that price has actually closed lower here, creating that liquidity pool to then expand to the upside. So we've broken structure to the upside. And in terms of how we get into the market, we use these areas created from this break of structure, i.e. imbalances, which you can see right here. Candles, which we didn't really come into, but if we can consider this area here, you can see we came back into it. But essentially, price comes back into this area here and then pushes higher in its intended direction. But if you look a little bit further into it, when price pushes above this high here, we break structure to the downside. We create this consolidation phase, which is liquidity. We break below the low and we break structure again, moving higher within our previous area. This is called reaccumulation. Again, this is going to be covered. Price then comes low, breaking that liquidity area here, pushes higher. There's another break of structure. I haven't highlighted this one, but we've covered above this high here. Price has broken lower, and then price is coming down. Price has come below these lows here, and then broken structure to the upside. So that signals your reversal. Reversals are absolute key to getting in the market in key areas. And again, if that's something that doesn't make sense at this moment in time, there's absolutely nothing to worry about. So consolidation. This is when price consolidates, the market is forming opinions, and that means creating liquidity. Consolidation is price moving sideways and not showing a willingness to have a directional bias. We look for the impulsive move away from consolidation before we identify key areas. So in other words, consolidation is not very nice trading conditions because it hasn't given us an intent, a bias to a certain area. So what we identify is the fact that it is consolidating and we want price to move away from the areas. It is ideal for price to take out both sides before moving to the expansion phase. Because liquidity is being created on both sides of the consolidation, it is then risky if it only expands in one direction because it's only going to have liquidity in the other side. So as we can see, we've kind of got this random movement of sideways action here. Now, it doesn't look as pretty on the charts as what it would maybe look inside your head, but essentially this is not market conditions. We can identify there's liquidity here, we can identify there's liquidity here, and this is where price is consolidating inside of this range. So we've got this low, we've got this high, and we've not actually broken any lower than this low, and we've not broken higher than this high, meaning that we are in a consolidation phase. We are doing nothing at this moment in time. There is no bias to the upside or the downside. And then it takes an expansion away from this area here for price to then come back and give us a rejection. Now, if this liquidity was taken out first, we probably wouldn't have had to come up and take this area here. But long story short, what you can see is price pushing low, coming in above this high here, breaking structure, i.e. reversing to the upside, coming back into a key area. This candle here can be considered your key area. You've got this imbalance, which you could have identified. You've got this last down candle. And then prices move to the upside, targeting the consolidation at the top side. So that is an area we are looking for. And this really is what you're going to be using for your phases. So to recap, you've got expansion, you've got retracement, you've got reversal, and you've got consolidation. And in terms of key areas, that is what we're going to go over in the next couple of lessons. So if you are unsure on what these phrases are, do not panic. It is going to be covered in the next topic. But with that, I will see you on the next lesson, guys.